everyone. If you are here for the Canadian Infrastructure Bank's fall market update, you are in the right place. I can just see many people still joining, so we'll give it just another 30 seconds or 60 seconds here. All right, welcome everyone. I am Candice Lang, President and CEO of the Canadian Chamber of Commerce. Bienvenue à tous, Tanzé, Anin. Welcome you today. And today's event will be in English, but I just welcomed you in 3 languages. But if you would prefer the simultaneous audio interpretation in French, and other languages, there's a QR code you can see right here on the presentation slides. And if you use that code and follow the prompts, you can access the translation feature. So I know we have many people with us today. Thank you again for joining us. I know you are joining from all over, and I'd like to recognize all the different traditional and ancestral Indigenous lands that you are joining from across the country today for our virtual event. I grew up in Treaty 6 territory, and I like to acknowledge the treaty territories and that Canada is in fact a treaty nation. But even if you didn't grow up or are from a numbered treaty area, I think the peace and friendship treaties that go much further back than our numbered treaties are just so important to how we have, how we think about this land we all call home, and we recognize and value the contributions of all First Nations, Inuit, and Métis people, and the role they have had in shaping and strengthening our shared lands. So I hope you're all familiar with the Canadian Chamber of Commerce, but if you're not, we are Canada's largest and most activated business network, and through our corporate members and chamber network, represent more than 200,000 businesses of all shapes and sizes and sectors across this country, and we are really that unified voice of business, and we work on things that matter to the country, to the success, the thriving business community. And I can tell you from conversations I've had in my first few months in this role that infrastructure comes up a lot, and specifically trade enabling infrastructure. And that is so important because I think, as we've talked about, especially more recently in the past week, as we look at trade being threatened by tariffs, we're just reminded how much of a trading nation we are as Canada. And in fact, that the vast majority, 2/3 of our economy is trade dependent. And so it is just such an important topic. I'm so glad you're all here with us today. It matters so much to Canadians across the country. And so the big questions are, what is the path forward for infrastructure? I look back myself personally, decades ago, just the dedication, the long-term thinking, the planning, at the investment that infrastructure requires. And so I know from just hearing from some of our panelists already that we're in for a good discussion today. And I hope answering some of your big questions, because there are big things to think about when we look at trade enabling infrastructure. So we're going to talk about the role of infrastructure banks, and we're going to look at, the cost-effective role that infrastructure banks can play in accelerating the development of what I just shared is much-needed public infrastructure. So last thing I'm going to share is just introductions and give you a sense of today's run of show and how we'll be approaching this webinar. So first up, we're going to have a moderated panel. And we're going to hear from leaders from the Scottish National Investment Bank, the Nordic Investment Bank, and Canada Infrastructure Bank. And this discussion will be moderated by Dr. Sébastien Berthermier. So thank you, our panelists, for all being here. Dr. Berthermier is from the Faculty of Management at McGill University and the Executive Director of the International Centre for Pension Management. But first up, we're going to hear firsthand from Ehren Cory. And Ehren is the Chief Executive Officer of the Canada Infrastructure Bank, or CIB, and he will share an update on the CIB's latest results, progress, and new investments. So the CIB has been in place since 2017 and has financed the development of infrastructure projects, and how we like to say, getting some of this progress unstuck and get things moving in terms of the investment we need in infrastructure. So very happy to now turn it over to Ehren. Ehren, the floor is yours.
Thank you so much, Candace. Great to be with you virtually today, and I am really looking forward to the conversation as well. At the CIB, we've tried every 6 months to provide, in both fall and spring, an update on our progress and activity. And today's format is a little different. I'm going to very briefly give you the overview of where the CIB stands, but then quickly, as you said, go into a panel discussion to talk about more generally how our infrastructure banks working around the world, because we are far from the only one. But to start with a snapshot of the CIB, the chart I hope you can all see now is the snapshot of our activity up to the end of our second quarter, so that would be September of this fall. And what it highlights is we have now crossed the $13 billion mark in terms of our dollars invested of our initial $35 billion appropriation. We have $13 billion of that committed across 75 projects in the country. And as you can say, they really are, if you look at the map, across the country in all 10 provinces. We have a number of really exciting things happening in the territories. So the next thing you can expect to see is some dots even further north on this map. I'm really excited about our partnership that we're developing in Nunavut, Northwest Territories, and Yukon. But looking today, you can see from east to west, we have projects, they cut across all of the sectors of investment. So Candace, you were talking about trade enabling infrastructure. That is part of our portfolio, talking about ports, airports, trade corridors. We're also invested in transit projects, clean power, green infrastructure, and broadband projects across the country. And as you can see at the top, there's a little red flag that talks about the 11 or so projects that are truly countrywide. So this would be things like electric vehicle charging networks, or things that you couldn't put a dot on a map because they go across the country. So great reach, great coverage across all sectors. And as it says, maybe most importantly, that represents about $36 billion of total capital value. So that's $36 billion of infrastructure projects happening that were stuck in this country. So we're very excited about that. Maybe the most important thing to say, though, about these projects is to just reflect on the impact of them. So Candace, you were talking about trade. The projects we've done so far lead to approximately $700 million a year in annual economic growth through increased trade. They also lead to 8.5 million tons of annual GHG reduction, 175,000 new transit riders, 450,000 homes connected to broadband that weren't in the country. So it's those measures of impact. And then lastly, and certainly not least, 15 of those 75 projects are in partnership with Indigenous communities and Indigenous economic development corporations. So we're very excited about that and think that's going to be even more important going forward. So those are the impacts we measure: the Indigenous economic participation, trade growth, GHG emission reduction, or decarbonizing our economy as we go, and then creating new connectivity of Canadians through broadband and transit. Those are our outcome measures that we care about. Just to highlight the most recent activity, two things I wanted to point out. So first, as you mentioned, Candace, in your intro, the CIB was started in 2017. Our first employee started in 2018. So we're about 6 years old as an organization. And so you go through a life cycle. And at first, the challenge was in signing investment agreements and starting to get money out the door. As I just showed on our chart, we're well into that process now. But now we're starting to see something even more exciting, which is projects going into operation. And this fall, 4 of our investments reached completion and are now in operation. So you can see a few weeks ago, the Beckevar Wind Power Project, which is located in Saskatchewan. A few weeks ago, a number of our team members were out there for the opening of the project. Modern Niagara was a building retrofit to drive energy efficiency in a 60 or 70-year-old building that recently reopened. There's a really exciting renewable energy project in Alberta, Deerfoot and Barlow, again in partnership with First Nations. And then our first ZEBS project to hit the road, the Edmonton Transit Project, the fleet of electric buses are now in operation. So we're very excited to now be tracking not only investment commitments and dollars out the door, but projects into operation. And it just reflects on the maturity that our organization's seeing. Let me talk to you about two projects that reached close this quarter, just to highlight the kinds of things we are now doing. Both of these, I think, are really illustrative of what the CIB has evolved to. So first, Brandon Water and Wastewater Project is an investment, $43 million or so of our money, paired with private capital in this case, which came from a Manitoba-based credit union. Really exciting to be partnered with them to deliver to Brandon an investment in their water, wastewater, stormwater capacity. And what that's doing is two things. It's replacing nearing end-of-life infrastructure in the community of Brandon. But secondly, it's expanding that capacity to support future home growth. So we worked with the city to understand their growth plans and to upsize infrastructure to meet their needs. And so this was the first of our investments that we call infrastructure for housing initiatives, so infrastructure that enables new housing growth. So we're very excited about that loan. And then the other one you can see on your screen is a solar project called the Quayam Solar Project, and very excited about this. It's in partner with the Nchakapum First Nation, or NNTC, a tribal council, and Blue Earth, a renewables company, who partnered together to build this really interesting solar project located in the traditional territories of the community. It'll produce clean power for several thousand homes, hundreds of construction jobs during construction, and then longer-term employment opportunities, and maybe most importantly, a chance for the First Nation to really get into the project development business. The partnership with Blue Earth is really allowing them to build the capacity to be the owners of renewable projects, which was very important to their community. So we're excited about that. That's the type of thing that we are working on constantly now. And I would just end by saying these are two illustrations of the 75 projects we're doing, and we are really in our stride now. So every year we're in the range of 20 to 30 new investments, so that's a couple every month. And each month we're making across the country these types of investments in the new infrastructure we're going to need to, yes, drive trade growth, yes, drive energy efficiency and growth in our electricity and energy grids, drive better connectivity of Canadians. So really excited and proud. And with that said, that's the quick tour de table, that's the quick overview of the last 6 months for the CIB. I'm now going to turn it over to Sebastien for the highlight of what I think will be a really interesting discussion. Sebastien started working on this research several months ago and has been interviewing folks here at the CIB, but also in Scotland and with the Nordic Bank. And so I'm excited to have my colleagues from around the world joining us. Sebastien, I'll turn it over to you.
Ehren, thank you. Good morning, everyone. Good afternoon. In addition to Ehren, I'm very pleased to be here with Jeanette Vitasp. Jeanette is the Vice President and Head of Lending at the Nordic Investment Bank. Jeanette is joining us from Helsinki, as well as Anne Al Denholm, who is the CEO of the Scottish National Investment Bank, joining us from Edinburgh. So we have a great panel today. The goal of the panel is to discuss what role infrastructure banks play in catalyzing private investments in infrastructure markets. So as Ehren mentioned, I've been doing a research study on this topic for the past several months. I'm expecting it to be published at the beginning of 2025. And the study is based on a series of interviews and case studies, and we'll discuss briefly about the case studies today. I'm not going to be able to share all the findings from the research in a few minutes here. But what's become really clear from the study is that there's different forms of market failure that are making it difficult to bring large-scale private financing to new infrastructure markets, especially markets that are dealing with the energy transition or the digital transition. Think of setting up new EV grids or carbon farming or battery energy storage or green steel or offshore wind ecosystems or data centers. When we dive in and understand that the different forms of market failures, there's really 5 that are coming out, and you can see how difficult these projects can be to build. They're new, they're complex, they don't have a proven track record. There's no assurance of stable revenue. It's not like building a bridge or a hospital. Oftentimes, you have to require the whole ecosystem to launch in order to get the project up and going. I mean, think of offshore wind energy. You need to import the materials. You need to install, maintain, distribute, store the energy. It's more than one project. It's an ecosystem of projects, so that requires coordination among the stakeholders in the industry. 3, they're large scale. So they involve multiple lenders. We're talking oftentimes of billion-dollar level projects. So you have multiple lenders, so you have to coordinate and make sure all the lenders are on board. They're undeveloped, so oftentimes they're highly fragmented, which means you may have to manage relationships or contracts with thousands of individuals. That's difficult from a scale perspective, especially for the private sector to launch. And then when you look at the activity of the infrastructure banks, and we'll getting in some of the case studies in just a minute, what's really interesting is they're able to step in because they have a higher level of risk tolerance than the private sector. They have a longer time horizon, and they have access to multiple financial levers. They're able to reduce the cost of capital. They're able, in some cases, to provide concessionary financing. They're able to de-risk the project. Think of taking some additional debt, junior debt, mezz debt, provide flexible payment terms, provide loan guarantees in some cases. They're able to act as anchor investors. So in doing so, they can help to coordinate stakeholders on the supply chain. They can help to coordinate other investors. And essentially what's happening is when the government's coming in, essentially through the infrastructure bank, they're sending a strong signal that the government is committed to the success of the ventures. And that's reassuring for the private sector to know that there's an anchor investor coming in. And then, well, the projects are new, so there's no track record. So then the banks are helping to establish a track record and show some market leadership. So I'm not going to say more because I really want to be here to hear from our panel. And many of you have submitted questions for this panel. Thank you for this. So what I try to do is to incorporate your questions into the mix. And so I'll bring them in. I'd like to start perhaps by having a discussion on some of the case studies. I'll start with you, Ehren, then I'll move on to you, Jeanette, and then Al. Ehren, one of the very interesting case study on the Canadian Infrastructure Bank has to do with Oneida Energy Storage. This is one of the largest world battery energy storage. I think it's Canada's largest. Yes. Was launched in 2020. A risky project because it's ultimately privately developed by a consortium of developers in southwestern Ontario. But you have the government on the other side as a client, and the government is of course getting the energy contract out of this. It's a risky project. It's risky for the private developer because, well, it's the cost of raw materials might change over time. There's lags between the moment you purchase to the moment the batteries are shipped. So you end up paying the cost of lithium, let's say, whenever the batteries are shipped. So that exposes risk to the developers. Government is doing it for the first time, so there's risk potentially of overpaying. The bank came in actually and played quite a big role in actually getting that ecosystem together and de-risking the project. Perhaps could you share some insights into that, how that worked?
Absolutely, Sebastien. And it is a great case study, and of course it's a project, as you said, we made our initial investment commitment to in 2021 and then closed a year later or so. So it was a great learning experience for us, and it infuses many of the deals we do today. I think, as you pointed out, the big role we were trying to play in that project was bridging that uncertainty challenge. So the developer had been working on the project for several years. They had an incredible vision of building this large-scale, grid-ready battery storage project to help incorporate the renewables that are in the Ontario grid today and to sort of create a smoothing. But they did face a number of challenges, and you're right. If you think about how most electricity assets get built in a regulated model, any risk of cost overrun, I mean, you'd go to the regulator and you'd get the cost increase approved, and really the only risk you're taking is on cost disallowance, meaning the regulator doesn't approve for the cost. That was not the case here. This is much more like a PPA situation where the operator was going to sign an agreement and they were going to be on the risk, therefore, for cost. And given global lithium prices and construction costs, is very uncertain. So that was one risk they were dealing with. The way we helped structure around that was to provide a loan that was actually pegged to global lithium prices, and the amount of our loan and the terms of our loans changed as lithium prices varied. Another risk, most of the revenue is going to be contracted, as you pointed out, but not all, especially in the later years. There was some merchant power risk. And again, investors just don't know how to think about that in a battery storage project that doesn't really exist. In a wind project, people know, okay, there's a PPA for 20 years or 25 years, and at the end, we'll have some merchant tail opportunity, and they kind of know how to model and think about that. But in a battery storage project, nobody knows what will the technology be like in those years. Will it be at end of life? Will it still have residual value? So there's a whole bunch of uncertainty around the tail end as well. So again, we were able to help bridge that by an investment product that helps share in that risk, help equity share in those risks. And as you said, the last thing, being early movers mattered. So we signed our agreement that allowed them to pull together the rest of their equity consortium and lending. So I think it was really important for us to be in early, and I think that's a lesson that you pointed out, but we on Oneida really felt was important. By us joining in and making a commitment to the project, it allowed them to arrange the rest of their financing and ultimately be in construction. And the project's meant to be electrified by, I think, June of next year, middle of next year, let's say, and so it's well underway. I've seen construction progress. We had a virtual tour last week, and construction is well advanced, and they're moving towards electrification in the first half of next year, which is really exciting.
So what's really interesting here is how the bank comes in almost as a bridging the gap. But the gap, you see it on both ends. You see it from the developers and a lot of new types of construction risks, and it's hard to finance. You're seeing it from the government. It's a new thing. There's a risk of potentially overpaying for this. And so here you're having a public institution that is run like a private operation very much, but a public institution helping to transact and get that market together and get the project up and going. And I mean, you would think once that's up and going, right, there's a framework that you can use for future projects, future battery energy storage moving forward.
Exactly. And Sebastian, I to that point, a lot of our thinking, and I'm interested in, I'll hear this from our colleagues as well, but we're trying to make markets, hopefully temporarily. I mean, the 10th or the 20th battery storage project in Canada, hopefully those market failures, those uncertainty gaps are addressed, and hopefully we're not needed. But I think when you're doing the first of those, when markets are still sorting themselves out and when there's that much uncertainty, that's where an infrastructure bank can play a particularly important role. And so we're often asking ourselves, people ask us, what's your exit strategy? And I don't mean that on an individual investment, but I mean it at a sector level, like building retrofits or electric buses or battery storage in this case. In each of them, what we're trying to think about is how can we help prove out or make a market, and then eventually, hopefully that market is functioning and doesn't need us.
That's great. Thank you, Ehren. Perhaps turning over to you, Jeanette, another really interesting project is the Green Steel project taking place all the way in northern Sweden in the town of Boden. We're looking at, I think, what might become the world's largest green steel manufacturer that can decarbonize, what is it, up to 95% of steel, which is major, right? Because you think of steel, steel manufacturing is 7 to 9% of global emissions, responsible for that much. So decarbonizing that much of it is huge. This is a private-led venture by a private company called Stegra, based in Stockholm, that is essentially building a whole integrated plant. And it's clever. It's done all the way up in northern Sweden. So you have access to water. From the water, you make hydrogen. From the hydrogen, you make green iron. From the iron, you make steel. So everything is linked all together. But you can imagine this is a major project. This $4 billion of debt, $6 billion of financing to get such a project underway. Took several years to get there. The NIB is one of the lenders. And interestingly, there's a use of guarantees that you're helping to actually de-risk the project too, doing some due diligence on the deal as well, showing a stamp of credibility. Could you perhaps elaborate on how the NIB intervened and the value of such a project?
Absolutely, I can. So this is a landmark transaction in the hard-to-abate steel production industry. So typically, this is an area where we would see market failure. I think it's above all the large scale. It's not so much the technology in itself that is new. It's the scale, and that's, as you mentioned, the $6 billion financing needed for a startup, big, huge startup. It requires a lot of coordination and support In this, that's where usually the project financing type of structure comes in, where you also try to ensure both that you have the supply both of energy and the raw material in secured, at least not entirely, but I think in this case 60% for the initial needs, and also in terms of the offset or the offtake agreement. So they have also spent a lot of time, of course, with end users, 20 plus end users, above all the European car industry, because this is also, you could say, a little bit expensive in the beginning. So you need to have end users that are willing to pay an extra premium for the green steel. And they have secured that. But so in that sense, where we come in is that we review the project, we evaluate the validity of the project and the expected impact of it, because that's basically what everyone invests in. So by doing so, even though us and together with the EIB, our sister bank, European Investment Bank, we invested around 300 million euros into this. I mean, it's only a fraction of what they kind of accumulated in 4.2 billion in euros in the debt financing from around 20 lenders. But so our portion is not that big, but our importance is that we actually put our quality stamp on the project as such, and that we also de-risk it in certain ways. We also we also have access to guarantee programs, as you mentioned. The InvestEU, we're an implementing partner of it, meaning that we can actually, and there are different types of focus areas. So the clean energy transition that EU is also supporting is something we can bring to this project, which not many other lenders can do. So we're actually supporting the de-risking of it as well. Yes, it's just a huge project with different pieces and bits and pieces and parts that needs to be evaluated and to secure the outcome.
The guarantee of it is a clever policy tool in a way, right? Because you're having governments providing guarantees to infrastructure banks to take on the risk. If everything goes well, there's no need to even guarantee, because the money is being recouped. So in a way, there is a guarantee to cover for the downside scenario, which in turn allows you to provide more cost-effective rates, which are themselves useful for the developers because you don't burden them with highly expensive debt to begin with.
Right, exactly. And you also have state guarantees from Sweden, for example, where they also support some of the commercial banks that come into with financing here as well. And this is back to the market failure and what Ehren just talked about, that when you talk about new types of technologies or markets to be built up, you need the support in the beginning, hopefully, because industry is leading the way here. Then once this kind of gets moving, our support might not be needed. We can put it elsewhere in other types of new technology. So I fully agree to that comment.
It's interesting to hear both from you. You're moving around, looking for these market failures, and then moving on. It's almost like firefighters, one at a time, right?
Right, exactly.
Thank you, Jeanette. I'll turn it over to you. One of the cases I found most interesting in speaking with you and your team was the development of the wind energy in Scotland, and in particular offshore wind. There's a lot of wind in Scotland.
Yes.
But it's not easy, right? Because if you want to get the offshore wind platforms, you can have the floating, the fixed. You need a whole ecosystem. I mean, you need to import the materials. They come in huge ships, one of the largest ships that I've seen. You need to import them. You have to store them. You have to install them. You have to maintain them afterwards. You then have to get all the distribution going right. Then it's an intermittent source of energy, so you might have some energy storage component to it as well. Getting such an ecosystem to begin with is hard. And what was really interesting was in the northern of Scotland by Inverness, you have this Ardésir port, repurposed port that used to be active in the 70s and 80s, that closed. And now that has been reopened. Again, a private developer has led the way, an American-led private investment company in Texas, actually, building that Haventus developer in Scotland, with about a 300 million pounds injection into it. And both the Scotland and the UKIB, which is now the National Wealth Fund, have come in and injected about $100 million of credit facility to the deal that was earlier this year or late last year, if I recall, which is critical to get that supply chain up and going. Perhaps could you elaborate on how that came about and the value of such a transaction?
Well, yes, thank you. Yes, to give a bit of background to this, why this port was so important, I'd like to start with the backdrop to the offshore wind opportunity. So Scotland, as I'm sure many people know, is world famous for its oil and gas capabilities. In any oil field globally, you'll probably hear a Scots person's voice or accent. But we're also we acknowledge that oil and gas is going to diminish over time. And so the Scottish government, and indeed many governments globally, have assessed that there needs to be a transition to renewables to replace the dwindling oil and gas resources that we have. And offshore wind and onshore wind and solar and tidal are all potential solutions to that. Now, one of the advantages that Scotland has is it does have a lot of wind. The North Sea has a lot of wind. It's also an area which is well known to the offshore oil and gas industry. So what the Scottish government did and what other parts of the UK government have done is they've licensed parts of the North Sea effectively to generation companies, so the big names that you'd expect, the Shells and so on, as an example, BP, Equinor, etc., to generate that wind energy over time. But then, to your point, you need to pull together an entire ecosystem to try to do that. Now, in the past, Scotland had become a reasonably strong leader in fixed base offshore wind, fixed base wind rather. But a lot of that development was an import-led model. So the turbines and the blades, etc., were manufactured in other countries and towed into Scotland and manufactured and assembled. Scottish government, UK government as well, supported the view that they should actually try to create an onshore or Scottish-based supply chain to enable this and try to capture more of that value. And the reason for that is we have more than 100,000 people involved in the oil and gas industry, and we want to transition those more than 100,000 people into the renewable industry. It's a similar skill set, we believe, and we should try transition that workforce. So with that in mind, to your point, you need to create a whole ecosystem. You need to create the OEM manufacturers, the blade manufacturers, the turbine manufacturers, the skills, the supply chain in terms of services. You mentioned boats, they're very large boats, it's large scale. So this is all on a big, big scale. If you take an oil and gas platform, the supply, that's out in the North Sea, the supply vessels now are quite small in scale. But if you want to construct offshore wind turbines, the vessels are so much bigger. And what you find is that the boats and the harbors are too small to support offshore wind. So we need to upgrade the harbors and the ports. So what we've been working on as a key strategy is looking around, not just ourselves, but all the people involved in this major project, all our stakeholders, to try to get the ports and harbors upgraded first. And then if you can do that, that then allows you to put the OEM, the blade manufacturers, the turbine manufacturers next to them, etc., and construct and assemble and move them offshore. So the first part of this program, if you like, or the most important part, we think the foundation to the whole project, which, by the way, Scotland is aiming for 35 gigawatts of wind power, which is bigger than the Inflation Reduction Act in America, was only 30 gigawatts. It's really massive scale, is to actually start with the ports. So we were approached, as you said, by Texas-based entrepreneurial company, Haventus, who came to us and said, we'd like to play into this large opportunity. And they asked us if we could help them with some debt funding. We initially, when they first came to us, we said, well, we looked at the business case. We said, I think you need to go, or we think you need to go and get some equity funding as well. You'll need equity and debt. They went away and they got the equity funding that they required. They then came back to us and said, could you come in with some more debt? Could you now do the debt financing? And we then worked with another UK infrastructure entity, the UK Infrastructure Bank, as it was called at the time, now called the National Wealth Fund, to work together to provide the debt to support that business. And between us, we both put in 50 million of long-term debt. Now, you're right, it's very important to think about the role of an infrastructure or development bank in this. There is a port that is based on a premise that offshore wind will be successful. It's a fairly new technology. It needs a supply chain. It's not an untested technology, but it's bigger in scale. It needs a supply chain, it needs large ports. There's no guarantee that there'll be revenues from the generation companies because they could take those generation contracts or those supply chain contracts elsewhere. But very helpfully, when those licenses were given out, there was a clause that those generators should seek to supply or to generate supply or use the Scottish-based or local supply chain. So that was what we were trying to facilitate. The good news is that deal closed. The 400 million was assembled. It closed just before the end of March of this year. The construction is proceeding at pace. They're ahead of schedule, which is great news. But what very importantly is it's now de-risking some other decisions. It's a bit like the Field of Dreams movie. You build it, they will come. And you're now seeing the OEM manufacturers now starting to think about putting manufacturing sheds there as well. That's then leading to, and these are quite big sums of money as well, obviously. That's leading to more infrastructure having to go into the area, more broadband. It's leading to other upgrades to the infrastructure in the area. It's also now leading to more housing needs. You've now got something that's going to create 3,000 to 4,000 jobs in an area that didn't have the housing to support that. So we're now talking with people about creating that housing need. And this is in an area which had, as you mentioned earlier, Sebastian, it had been the centre of an oil fabrication yard in the 70s and 80s, employing 4,000 people. It was shut down. It went to zero. And now it's been regenerated through this transition to renewables. So I think it's a fabulous case study for how a development bank can come in and support.
What's really interesting to hear from you is it's incredibly hard to get the supply chain to get everything up and going. But once you do, the gains of especially being an anchor investor and having that supply chain up and running are exponential, because you're sparking a whole industry, which is much more ultimately than just a win. It's the jobs being created all around, the housing components. It's a spark of a much larger fire.
Exactly, and it's acting as a catalytic effect for a ripple of additional activities in the whole region, which will be a benefit in many ways. It'll support restaurants, support hotels, it'll support so many businesses in that area, not just people working at the port. So
I'll come back to you on that, because I want to get more into how do we measure the impact of such a thing. But before I do that, I think one of the striking things that came back from all three of you is that, okay, there's a market failure here. It's hard to come in. You're helping to get that private investment up and going, but you're doing it not by putting grants. You're doing it by putting loans. And this is a loan that you're expecting to be paid back. So ultimately, all of that investment, right, as opposed to providing a grant, which is I provide a grant, I don't expect to recoup the capital. Here, you're expecting to recoup the capital and earn interest on top of it. So that really highlights the cost efficiency, which is a point Candace raised in her introduction remarks, the cost efficiency of the model. And I'm turning over to you, Jeanette, because what's interesting about the NIB is that it's been there since 1975. So now you have, close to 50 years of operations. Can you speak about the sustainability of the model and how much does it cost the government, so to speak, to run such an agency?
Well, we are not profit maximizing, but we are actually aiming for profit. When we were established, we got the capital injection, so paid in capital We also, I think this was, as you say, 75. 1982, we got an extra injection because the demand was so big. And then but it has been profit making. We have been profit making since day one. When this was first, the 5 Nordic countries has established the bank, and then in 2005, the Baltic countries joined, and then there was an additional piece of capital paid in. But that was basically, you could say that, and then it took until 2020 when we had the COVID year, when there was some, but also what happened is that already after 1982, when we actually got a little bit of extra paid in capital, we also started paying dividends. So we have paid dividends every year except for the COVID year. But apart from that, we've been paying in dividends. Our policy is around 20 to 30% of our net profits. We also then have to consider that it's also after having set aside the buffers we need in order to also maintain our AAA rating. So it's basically our owners have, I would say that the total paid in capital that we have on our books today is 850 million euros roughly. Out of our total equity is around 4.5 billion euros, and we have a balance sheet around 40 billion euros and a loan portfolio of 22. So it's actually, and you get paid back plus the value, of course, of what we have in our stock. So I would say that it's a standalone profitable business in that sense. We are basically trying to stay close to market terms on the loans we provide and rather contribute with say stability in terms of long-term funding and also the risk taking.
It's interesting to hear you that you've been paying back dividends. So in a way, generating positive social economic impact while generating a profit and returning it ultimately to governments, at least some of it. I think if I go back, it's about 20 to 30% of net profit you aim to return back as a dividend.
Right.
Now, so we have the financial profit, but we have the impact. And I'm coming back to you on that point, Al. You've mentioned the impact that is actually quite non-linear in a way. I mean, you have the impact on jobs, you have the impact on housing, you have the impact, of course, on the decarbonization, which is one of the of the whole industry, which is one of the goals of the project. How do you measure such an impact? It seems to me that just measuring the scope 1 reduction that you might get from this might unfairly capture the full gain of actually creating that ecosystem.
Well, so yes, we so again, in context, a bit like Jeanette, we invest on a commercial basis. So we're looking to make a commercial return. And in fact, in the Act of Parliament that was used to set us up, we're not allowed to do anything on a sub-commercial basis. So that's very important. We don't do grants, as you say. We only make commercial loans or commercial equity investments. But we also, and we're younger than NIB, and I hope in time, we will be able to pay dividends, etc. But that's a bit early for us. But we are now profitable. We cover our operating costs, and after only 3 years we covered our operating costs, and we believe we're now in a sustainable position in doing that going forward as our portfolio builds. The other thing that you quite rightly think, we also look at the impact benefit of our investments, and that impact we think in very general terms is societal benefit and environmental benefit. And the societal benefit and environmental benefit are something that we put into. We have a number of KPIs we put into the terms of our loans or our investments. If someone wants our money, then these are the terms on which they must take it, and they must adhere to improving their own activities in certain areas, whether that be working practices, ED&I practices, gender pay gap analysis, TCFD or carbon management plans, etc. And there's a whole scope of those. So we put that into our conditions, and we gather information from every single investment that we make every 6 months and pull all that together and collate it. And we publish those outcomes in our annual report and our impact reports. Is very visible. And part of the reason for doing that is we think we can also act as a catalyst to help make companies and the wider ecosystem more impactful as well. So it's not just our money that's been invested for impact, their activities are also becoming more impactful. So again, we talked about the ripple effect. You can create a ripple effect. So if we're investing in a small equity firm and they start putting these ideas into their own supply chains, then you get that ripple effect. So that's what we're trying to do. You're right, it's quite difficult to measure it. We do measure it, we do publish on it. It's audited, as you can imagine. But I think we started off as we mean to continue. So we've been doing this from day one. So it's a bit easier than going back the way and trying to retrofit. So
Thank you, Al. Turning over to you, Ehren. One of the patterns, again, that you've all mentioned through the different case studies is you're doing very careful due diligence, very similar to the way the private banks would. And it's because when you look at your teams, I mean, your teams hire a lot of people from the private markets. You're also making investment decisions that are actually fairly independent. Each at the deal level, most of the investment decisions might be independent of government. You may not need government approval. But at the same time, and this is where it gets really interesting, at the same time, I mean, these are public institutions that are ultimately investing as a government policy tool, right? Where you're investing in a way in line with government set priorities. And so how do you find that, how are you getting the sweet spot of the balance between respecting public sector priorities dictated by the government, yet at the same time, while having a private operation running, identifying deals, and having that nimbleness and agility to act without seeking perhaps approval at the government for every deal that you make?
Yeah, it's a great question, Sebastian. And interestingly, I think if you were to ask all three of us on the call and other colleagues, I think this is one place there are subtle differences country to country, but maybe like some similar principles at the root. Because I think all of us have in some way, shape, or form, we are public institutions. We are meant to deliver on some form of public policy. And so getting that balance right, you know, and Jeanette has 8, or I don't know how many how many different country members, but so that's probably a bit different, but I bet some of the same principles would be true. The way we think about it, and it took us a few years, I would say, to fully flesh this out, is step one, it is absolutely government's role to think about portfolio allocation. What are the types of things that they care about? And the best way they do that for us is they set outcome targets. And Al, totally in line with what Al was saying, for us, the Government of Canada talks to us about our goals around reducing carbon intensity of the economy, driving GDP growth through better trade, driving better connectivity of Canadians through transit and digital connectivity, and driving economic inclusion for Indigenous peoples. So those measures. Oh, and starting last year, building the infrastructure that enables new housing growth, given the housing crisis we face in Canada. So government's control, if you will, for us is to say, those are the things we want you to get, and they set long-term targets for us on each of those measures. From there, as investors, it's our job to translate that into, if for lack of a better term, ROI calculations. So we actually think of our hurdle rate in our investments, dollars invested in a clean power project. So we think of GHGs per dollar invested, or GHGs per dollar of risk we take. And unlike Al, your description of the Scottish investment bank, we actually are not designed to be on fully commercial terms. And that's because we're willing to take less than commercial terms for great outcomes. And so we think of a sliding scale. Imagine if someone brought us a project that was massively decarbonizing, like Jeanette's green steel project that delivered, I don't know, millions of tons of GHG emissions reductions per year. We would be willing to take more risk on that project than something else that was more marginal, where we would be much closer to commercial terms. So we actually have we do that not just conceptually, Sebastian, but that for us, that's math, because we're bankers and because we like to think in math terms. So we literally create a hurdle rate, if you will, an ROI calculation. So the bigger the outcome, the more concessionary we would be willing to be. And I think that's one of the things that borrowers from us sometimes have a struggle understanding from us, is that we're completely disciplined investors. We're a lot like your other banks, but we have this other thing we care about in addition to the financial terms, which is the outcome, which we need to rigorously measure and be able to compare. Anyway, but back to your question, why that's so important is with that framework in place, we can have a mature relationship with our shareholder, which is the Government of Canada, where they say, these are the things we care about, and we say, right, we'll go get you those, we'll go make investments that deliver those, and they don't ever, aren't involved in individual investment decisions in any way. But what they're involved in is, their control point is not, should we do deal X and did we get good terms? Their control point is, we've given you a pot of money and we've given you a set of outcomes. Are you delivering those through your portfolio of investments? So that's, I think, how we do it. I think it works really well. People talk a lot about the independence that an infrastructure bank like ours needs to have. And I think there is an important role for investment independence. But I think it's also important to acknowledge that we are delivering on public policy outcomes for the shareholder. So it's not complete independence. It's this balance in taking priorities or direction from them and making good investments on their behalf.
So following up on that, I want to turn over to you, Jeanette, because the NIB, again, has been there since 1975. And you must have had some shifts in policy priorities from governments, especially now you had 5 Nordic countries, now it's the 5 Nordics and the 3 Baltics. So building on what Ehren just described and having that combination of an independent decision framework at the deal level with while respecting the strategic priorities. What do you do when those strategic priorities shift? Because if they shift a lot, I mean, I can imagine that's hard, right? I mean, you have a whole set of expertise, you've invested in that expertise. How do you manage these shifts over time?
First of all, it's been surprisingly stable, I would say. The bank was established with the ambition to invest in projects that would benefit the prosperity of the region. So this has been basically the guiding star, you could say. I think that with the first, at least what I have spotted in terms of the first climate transaction or green transaction was done somewhere around 1983 or so, but we did actually in 1999 define the policies to be, or the mandate to be dual productivity and or environmental. So, and this has been the case. The only thing we have shifted is that we've become a little bit smarter in terms of setting the high criteria for actually scoring the projects and setting targets in terms of the scoring being really, really high. We call it like good or excellent. And today, I mean, for both last year and this year, it's kind of like 100% of everything we do. We have a KPI of 95 right now, but we're actually delivering more than that. So you could say that that covers quite a lot, productivity, environment. But what has happened, of course, is that there have been, you can see that there are some instances where we need to play a bigger role. I mean, COVID was one part, but there has also been during financial crisis, etc. Right now, we are in our region very exposed to geopolitical risks. So our board of governors, the ministries, the finance ministers basically had meeting earlier in March this year, where this was also discussed, and the need for security and resilience in the region. So we had every third year we review our sustainability policy, and it was coming up this year. So we did actually change our exclusion criteria to also allow for investments in the defense area as long as it's non-lethal, so no weapons and ammunition. And you could say that we haven't really established that as a new kind of mandate. It's more like an exclusion thing or like an add-on to it, but it really depends, because you can see, as Ehren also mentioned, we're here to basically serve a purpose. What is relevant to our owners? And I think it is pretty obvious in this region that we have very much common, from a political perspective, common ambitions. And when we can define those that are common to the region, this is also something that we try to help out with. So this is actually where we have added now. But we also occasionally look at some strategic initiatives, or we see that we want to do more in the Arctic region. We put that as a separate sub-initiative, but it's not something we measure and that our investors hold us accountable for in that sense. It's kind of just, we know that if we can tick more boxes of what's relevant right now, it's really about also making sure that the private sector in Baltics can grow stronger, etc. So, but these are tweaks. I would say the main thing, the productivity, environmental, has stayed there for quite a few years now, and now looking into also supporting the resilience and security. So pretty stable. But this is, of course, a discussion you have to have on an ongoing basis with your owners. So what role can we play? Where are we kind of, where do we have the value add to bring compared to other players? And I think that's a very super interesting dialogue, because the most important thing is that we stay relevant to these countries, and things will shift. And even if we come back to the fact that whatever we have done is still relevant, that's good, but we need to continuously review it.
Jeanette, thank you. I'm keeping track of time. We only have a couple minutes left before we conclude. So perhaps can I ask you a very quick question to conclude? This is a fairly new, well, except maybe for the Nordic investment bank, because you've been there for a while. But in general, and this is something that I've seen across all the interviews that I've done, the infrastructure banks are fairly new. We're looking at them typically 10 years or less. It's a very different business model, as we've seen, much more private sector oriented within, of course, a public policy structure. So not easy to understand, especially when you're not used to such a model. In your view, what's the biggest and if you can take 30 seconds to a minute, not more, in your view, what is the biggest misconception that people can have about infrastructure banks? I'll start with you, Ehren, and then going down to you, Al, and then Jeanette.
Sure. Well, I think certainly in our market, and you're right, I mean, you have the Nordic Bank, there's also KfW, if you think of like historically, and the EIB have been around, but in the UK and in Scotland, in Australia, in Canada, there are many of these that are more recent. So I think you're right. It's definitely a growing phenomenon. I think the biggest challenge still, at least in our market, I'll speak for Canada, most of our listeners are Canadian probably, is just understanding the commercial, that we are commercial at our root. And what I mean, so first of all, for our government colleagues, you know, my shareholder, I'm a Crown corporation, they have to get out of the mindset of thinking of us like a grant, you know, so sometimes for instance, we have $35 billion in our appropriation. If you think of a $35 billion grant program, you'd put that money out once and it would be gone. Yeah. We are an investment vehicle. We've already started getting repayments. Similar to Al, our interest today exceeds our operating costs already. So we are on that measure already at a point of sustainability and only growing from there. And I think that you have to really think about us differently. We don't have $35 billion to invest. We have a $35 billion portfolio that we're turning. We're already starting to get repayment and put that money back out. And similarly on the private side, I think the misconception is that we're not totally government, you know, so we have borrowers who say, why are you asking us for all this due diligence and all of this paperwork? And we're a bank. So there's a bit of a sense of like, so we need to just, I think, educate both sides of the market. Government to think of us more commercially, borrowers to also think of us that way. We have a different return target than other lenders because we're willing to take more risk and because we value those long-term outcomes. But other than that, we are fundamentally commercially behaving. And so I think that's an education or a misconception that we're working on.
Thank you, Ehren. Al, over to you, 30 seconds.
Yeah, I recognize everything that Ehren has said. We've got the same balance that we're trying to strike. I think because we are so new, we're only 4 years old, we had our 4th birthday just last weekend. There's also an education of who we are, who we're not. And therefore, we have had these misperceptions of that, and we're working our way through that. And I think the key is to maintain our discipline. We're in between private sector and public sector. We're different. We have a connection to both. The key thing, I think, you talked about that, perhaps we're a bit less disciplined. We are absolutely as disciplined as the private sector. We don't cut any corners. We're stewards of taxpayers' money. We seek to invest that with high integrity and in a good way. Some other people do question, why on earth should a government entity be involved in investment at all. And, so we've managed to move people away from that as we demonstrate the benefit and role. And that noise is beginning to drop and dissipate, which is very, very good. The final one, just to make you laugh, I think, is when we first opened, we actually had people asking, if the retail customers asking if the public, if they could deposit some money with us. They thought we were a retail bank. But that's no longer happening as well, I'm pleased to say.
Thank you, Al. Jeanette, last word to you.
Okay, I think a lot has already been said in terms of who we are. That's sometimes we're also referring to, of course, taxpayers' money, but also considering that, well, it's not that all money comes straight from the governments in our owners and go past through our bank into investment, but we do raise the majority of our funding in international capital markets based on our AAA, and our AAA rating is not based on our owners' ratings only, because it's only like 70% of our total capital paid in that relates to that. So it's Sweden, Denmark, Norway that has AAA rating. Our other member countries do not. So it's also about how we operate, how we structure, how diligent we are in terms of our risk model and operations and portfolio quality, etc., and management that contributes to our AAA rating that we can then make benefit of in terms of actually attracting capital from the entire world into our region to invest there. So I think there is a misconception sometimes when we talk about taxpayers' money, but this is also why we think it is important to try to stay commercial, also to show that the terms we are actually generating is because we are acting on behalf in terms of the purpose for the governments, but we can find the funds elsewhere.
Well, Jeanette, Al, Ehren, thank you so much. That was an insightful discussion. Very pleased to have been able to exchange with you on this topic. I want to thank the Canadian Chamber of Commerce for organizing and hosting us. Thank you all for coming in and listening to us and your questions. And stay tuned, and we'll be happy to share the research study when it comes out in a few weeks. And on that note, wishing you all a great rest of the morning, afternoon, or evening, wherever you are. And goodbye.
Thank you.
Thank you.